This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com. This is the third of a series of lectures on Chapter 18 of the Paper P4 course notes on foreign exchange risk management. And we're still, for the moment, covering what should be a revision of Paper F9. But if it's a while since you did F9, or if in fact you studied under the old syllabus, then of course it's a bit more than revision. However, we talked about ways in which we can attempt to remove or reduce the transaction risk, the risk of exchange rates changing. And the first one we're going to look at in terms of the numbers is the easiest of all, both for the exam and in real life, in fact. Something called forward contracts. And all a forward contract is this, that if you know you're going to need, let's say, some dollars in 6 weeks' time, you've really two choices. You can either just wait for 6 weeks and then change the money, but if you do that, you're left at risk, because in 6 weeks' time, of course, the exchange rate could be anything. Or alternatively, you can go to the bank today, tell them that you'll want $100,000 in 6 weeks, and the bank will quote you a rate today to apply in 6 weeks' time. And that's all it is. It's a rate quoted now to apply to a fixed amount on a fixed future date. Now I'll show you with numbers in a second. It's terribly easy. But they quote the rate now. You don't actually do any converting now. Today you sort of agree it, but if you agree the rate, then you must convert the agreed amount on the agreed date at that rate. So whatever happens to the actual exchange rate in 6 weeks' time or whenever is irrelevant. You have to convert the agreed rate. Let me make it clear that you're happy what I mean. Look at example 3 on page 100 of the course notes. Do remember, sorry repeating from earlier lectures, but in all these examples, assume we're in the UK unless you're actually told different. Well, example 3, X is due to pay 200,000 in 1 month's time. Now it tells us what the spot rate is. Well, the spot rate is today's exchange rate. So that, of course, isn't particularly relevant because we're not going to convert the money today. We are going to convert in a month, and in a month's time, that exchange rate could have changed to anything. However, the bank is quoted for us a forward rate, and it says there's a 1 month forward rate. Dollar pound 1.4910 to 1.4970. Well, as I said a moment ago, that's a rate quoted today. So today they quote a spot for changing money today. They've quoted this 1 month forward rate. But if we agree to this, then in 1 month's time, we have to convert at that fixed rate. Well, it says if X contracts 1 month forward, so if we do agree to this, how much will we have to pay in 1 month's time? Well, in 1 month, we have to convert our 200,000 at that rate. $200,000. The forward rate, there's a spread. We will apply it in the normal way. But here there's $1.49 to the pound, so divide by 1.49. And which one will it be? Well, here we're paying dollars, so we need to buy dollars. So the dollar buy rate. 1.4910, I'm sorry. And so 200,000 divided by 1.4910, it'll cost us £134,138. That's how much we'll have to pay in 1 month's time. Remember, we don't pay anything today. All we do today is, if you like, sign the agreement. But we'll pay 134 in 1 month, and it is fixed. In that sense, there's no risk at all. Clearly, in a month's time, the spot rate, the actual exchange rate, may be better, may be worse, but we've no choice. Remember, we're not doing this in order to make gains or losses particularly. We're doing it to avoid risk. If we'd done nothing at all and simply converted at what the rate is in a month, well, we've no idea what it'll end up being. It could be higher, could be lower. But having gone for the forward rate, it is completely fixed. It will be exactly 134,138. The only problem, but this is just for the written part of the question, the only problem is that we are committed to convert 200,000 in 1 month. Where the problem comes is either if the amount changes, what happens if we decide we only need 100,000 for some reason? Well, we're committed. We've got to convert 200,000. And if we don't need the dollars, we're going to have to sell them back at whatever the spot is. Or, of course, if the date changes. So as we find out, we need to make the payment in 3 weeks' time instead of 4 weeks. Well, this commitment is to convert money in 1 month's time. We can't suddenly bring it forward, or for that matter, delay it. So provided we're certain of the amount and the date, this is wonderful. It's very easy. Clearly easy numbers for the exam so far, but equally in real life, it really is just a phone call to the bank. Just one other thing, though, which hasn't happened in the exam recently, but certainly has a few times in the past, is a way they quote forward rates in the newspapers. You see, the one I just gave you is what effectively what we call OTC, or over the counter. And over the counter is where effectively it's what you might call a private deal with the bank. And that's the way I've been expressing it so far, that you go to the bank, you tell them how much you need, on what date, they quote you a rate. And if you're happy with it, you agree to it. If you're not happy, try a different bank. You know, they can quote whatever they like, really. It's just a private deal. However, certainly for major currencies, and for standard time periods, 1 month, 2 months, 3 months, forward rates are also quoted in the newspaper. And the way they quote them in the newspaper is at first glance slightly confusing. And although, as I say, he hasn't done this recently in the exam, it has been there in the past, where he's given you forward rates, but he's giving you them in the form that they quoted. And look at example 4. Y is due to receive $150,000 in 3 months. I've told you the spot rate, and the spot rate, remember, is the exchange rate for converting money today. So 1.5326 to 1.5385. So if we were to convert today, no problem. There's the exchange rate. We want a 3-month forward rate. But look at the quote here. It says 3-month forward. 0.62 to 0.51. And I'll explain what the CPM stand for in 1 second. But what they've quoted there, instead of quoting as an exact rate of 1.6 to 1.7 or something, that 0.62 to 0.51 is the difference from the spot rate. So the actual forward rate, we need to adjust the spot rate by the difference to get the forward rate. But there are 2 problems. The spot rate here was quoted in dollars. £1 is worth $1.5. The difference they've quoted is always in the smaller unit of currency. And so that difference of 0.62 isn't $0.62. The smaller unit of currency is cents. It's actually 0.62 cents, which is what the C stands for. And so surely in dollars, 1 cent is $0.01, 0.6 cents is 0.0062 cents. Dollars, I beg your pardon. And again, 0.51 cents, it doesn't mean 51 cents, it's 0.51 cents. And so in dollars, it's 0.0051. So there's our first, I don't know if problem's the right word, it's terminology. But if it's ever quoted like this, they're giving you the difference, but it's always in the smaller unit of currency. And in fact, the C isn't always printed. So even if I hadn't put C there, it would be automatic. 0.62 cents, $0.0062. Well, again, the forward rate. We're going to take the spot. We're going to adjust by the difference. But of course, we need to know whether to add or subtract to get to the forward rate. Well, that's what the letters PUM stand for. Now, this may look very funny for the moment. Be patient with me, and I'll tell you afterwards why the rule's what it is. But if it's quoted PUM, then we take the difference, and to adjust, we add it to spot. Oh, I've already gone wrong. I am sorry. I said this is going to look funny. I do apologise. If it's quoted PUM, PUM stands for premium. We subtract from spot. And so, just doing the arithmetic, before I explain why we subtract, if you do the arithmetic, the spot is 1.5326, subtract 0.0062, and we get a forward rate of 1.5264. Again, we have the spread in the normal way, so 1.5385 minus 0.0051 gives us 1.5334. And there is the forward rate. And before I say more, just let's finish off the numbers on this example. Once you've got the forward rate, it's just like example 3, the one above, that the amount, how much was it? We're going to receive $150,000. Here it's $1.5 to the pound, so divide by the relevant rate. And because we're receiving it, to convert to pounds, we'll sell dollars to the bank. The dollar sell rate, 1.5334, converts to $97822. So the arithmetic's not really any harder, it is only terminology. Remember, the difference they're giving is in units of smaller currency. And to know whether to add or subtract, well, I've already said if it's quoted PUM, it stands for premium, you subtract from spot. And the alternative, if it's quoted DIS, if it's got DIS against it, DIS stands for discount. And if it's quoted at a discount, you add to spot. Now I appreciate that looks a bit strange. I mean, obviously normally if you're told something's a premium, you expect to add it. The reason we subtract is this. Look at the original example. At the moment, just looking at the first rate, £1 is worth $1.5326. The forward rate that's quoted, £1 will only buy $1.5264. And what's happening is effectively they're quoting as though the dollar is strengthening. If the dollar is stronger, £1 will buy fewer dollars. And so they're really saying that they're quoting the dollar at a premium. Again, if the dollar's at a premium, if the dollar's stronger, £1 will buy fewer dollars. And so it does make sense that when it's quoted at a premium, it means the dollar's at a premium. Dollars at a premium, fewer dollars to the pound, therefore you'll subtract from spot. And the same logic in reverse, if it's quoted at a discount. Now that's the reason for it. To be honest though, in the middle of an exam, you don't want to, if it's obvious, great, but you don't want to waste too much time thinking that through. The way I remember it, despite my stupid error a few minutes ago, is it's quite simply, it's the opposite of what you'd expect. You deduct a premium, you add a discount. Otherwise, it is just, as I say, fairly simple arithmetic. Have a go at example 5, though, to make sure you've got it. You have a go, then switch the recording back on and check me. Okay, well, the spot rate, today's exchange rate, 1.6582, 1.6623. The 2-month forward, we need money here in 2 months' time. So the 2-month forward, well, again, they've given us the difference. And I did say earlier, they don't actually need to put C for cents against it. That difference is automatically the smaller unit of currency. So 0.83 is 0.0083, 0.92, 0.0092. The actual 2-month forward rate, therefore, adjust by the difference. It was quoted at a discount, so we add a discount. And the 2-month forward, 1.6582 plus 0.0083, 1.6665, the other one, 1.6715. Let's actually do the conversion. It's $200,000. $1.6 to the pound will divide by the relevant rate. And here, which way? We're buying dollars. And therefore, Yes, sorry, we're buying dollars. It's 1.6665, the dollar buy rate. You should have got £120,012. And there we are. Incidentally, as I hope you realised when you were doing it, is if this were in an exam, we could have saved a few seconds, in that we could have checked first of all, which of the two rates do we need? Since we're buying dollars, it's this rate we need. And therefore, you didn't really need to do that bit of arithmetic. I mean, it's only a few seconds, but obviously time counts. But we only needed to do the arithmetic on the dollar buy rate. Anyway, that's forward contracts. At the top of page 101, I've left space for advantages, disadvantages. There's more to say later. Really, any discussion here would be comparing the different methods, and we've yet to look at money markets and so on. For the moment, though, it's what I said earlier, that the real advantage is that it is completely fixed. Using a forward rate, the amount is certain. The problem, the disadvantage, is that we have to convert a fixed amount on a fixed date. So if we're certain about the amount, we're certain about the date, no problem at all. But in real life, of course, those problems could end up being rather major. However, we'll leave that there. In the next lecture, we'll look at money market hedging, which needs slightly more thought.